Hello and welcome to the channel. Today we are tackling a topic that every software founder, IT project manager, and tech professional must understand. Even if you are not an accountant, and trust me, I'm not an accountant. We are talking about revenue recognition, especially how it works in SaaS, hardware as a product, hardware as a service, and why deferred revenue is such a big deal. Recently, this has been kind of big topic in my project, so I would like to share with you what I've learned. If you've ever wondered, why can't we just book revenue when the customer pays? What's the difference between selling hardware and renting it? And how does SaaS revenue actually get recognized? Then, this video will make everything crystal clear, at least I hope. So let's dive in. So number one, what is revenue recognition? Revenue recognition is simply the rule that tells companies when you are allowed to record revenue. And here's the golden rule. You recognize revenue when you deliver value, not when the money hits your bank account. Very important. So even if customer pays upfront, if you haven't delivered the service yet, you can't recognize the revenue yet. This is why revenue recognition, it's a huge deal in subscription businesses. So let's talk about revenue streams in software services. Most software companies have several types of revenue. We have SaaS subscriptions, so software as a service. We have professional services, support and maintenance, hardware sales or rentals, and we have usage-based billing. And each of these gets recognized differently. So let's break it down. Starting with SaaS revenue recognition. So with SaaS, customer is buying access over time. So for example, customer pays 1,200 euros for 12-month subscription. They pay upfront, but you can't book this 1,200 as revenue on day one. Instead, you basically recognize 100 every month. The rest of this sits on your balance sheet as so-called deferred revenue. As each month passes, you earn portion of the contract. So basically, meaning that the SaaS revenue is always recognized over time. Now let's talk about professional services. If you sell implementation, integration, or customization work, you recognize revenue as you perform the work. So typically, this can be done by percentage of the completion or through milestones that you defined or hours delivered. If the customer pays upfront, great, but you still only recognize revenue once the work is actually delivered. So now let's get into the big question. What happens when you have software and hardware mix? So in this case, we have SaaS plus HaaP versus HaaS, so hardware as a service. So there are two scenarios. So we start with the first scenario. We have software as a service plus hardware as a product. So this is basically when you sell the hardware, meaning the customer owns it. Now, the customer is owner of these goods. So for example, you sell a device for, let's say, 1,000 euros, and in addition, also the software as a service, so SaaS, for 50 euros a month. So how does it look with recognition now? So the hardware part, it's recognized in basically point in time, usually when it gets delivered. And for the software, so for the SaaS, this gets recognized over time, in this case monthly. This means you often recognize most revenue on day one for the hardware, and then the rest over time. Now the second scenario with HaaS, so hardware as a service. This is completely different. Here you don't sell the hardware. The customer rents this or uses this as part of the subscription. So, for example, we have 120 euros per month for hardware, plus the software, plus support. So again, how does it look now with the recognition? So the hardware is over time, so recognized over time. Same goes for the software and same goes for the support, because it's literally part of one bundle. Yeah? Because the customer never owns the device, the hardware behaves basically like a rental. And normally after the end of this, they have to return it back. And yeah, it's like a rental service, not really a product sale. And in most contracts, it becomes basically single bundled performance, performance obligation, which is then delivered over time. So what are the key differences? I would say it's actually simple. So think about it like this. So if the customer owns the hardware, then the revenue recognition is at point in time. As I said, normally at the delivery. If the customer only uses the hardware, then the revenue is recognized over time. So it's basically ownership versus access. And that's basically the entire difference. Now, so now we hopefully understand the models. So let me explain the deferred revenue. This concept basically ties everything together. So deferred revenue is money you have collected but haven't earned yet. It's not revenue, it's actually a liability because you owe the customer future service. Now, let me give you an example. So customer pays, we already talked about this, right? So customer pays 1,200 euros upfront for 1 year of software as a service. So for 1 year of SaaS. So that means in day one, when they order, we got 1,200 in cash and we have deferred revenue 1,200 and earned revenue is 0. Now, let's see how it looks in the first month. So you can see that one portion, and we have, because we have 12 months and it gets monthly basically recognized, then every single month there will be 100 euros deduction on the deferred revenue, and we will have basically actual earned revenue plus 100. So month 1, we will have remaining 1,100 as a deferred revenue and earned revenue 100. Month 2, again, minus 100, we are now at 1,000 and earned revenue 200. And this goes like this across all the months, yeah, until we reach the end of the year. So the 12th month, by the end, there is basically no remaining deferred revenue, and earned revenue is then fully basically the 1,200. So you didn't earn the money when they paid, yeah, you earn it as you deliver. That's really the point of this explanation. So for tech companies, deferred revenue, it's not a problem. Yeah? It's actually a strength. It means that customer prepaid you. It also means that your cash flow is strong. That's a good sign. You have guaranteed future revenue, and your investors see stability. Yeah? So high deferred revenue means basically high customer commitment, and that's great. That's a good sign. So now let's wrap it up. So revenue is recognized when value is delivered. Or let's say in case of SaaS, this happens over time. Then in case of implementation, so the professional services, it happens as work is done. For HaaP, the hardware revenue upfront, we said basically most probably when the physical hardware is delivered. Then for HaaS, for hardware as a service, revenue spread over time. And we also talked about deferred revenue, which is basically prepaid services not yet earned. Yeah? So master these concepts and you will understand how I would say nearly every modern tech company reports revenue. From startups, small startups, to giants like, I don't know, Salesforce, Adobe, or Apple. So, if you found this video valuable and you want to learn more about IT project management, I strongly recommend you to register for my free training. So click the link in the description, grab your seat, and join the free training. See you inside.